David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from D.L. Blain and Company in New Bern, here's David Blain.
Hello, I'm David Blain, and welcome to All Things Money. For the next 30 minutes, we'll take an entertaining, educational, and stimulating look at issues affecting your money. We'll take a look at investments, taxes, maybe some real estate. We'll give you some information and actionable ideas that can help you maintain or grow your wealth. Remember, the show is about you and your money, so if you have questions or comments, feel free to give us a call at 252-633-0107 or email us at allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. Or you can visit on the web at www.dlblain.com. That's www.dlblain.com. And there you'll find a lot of information on myself, our firm, as well as archived copies of the shows if you'd like to listen to them. Well, tonight, or today, depending on when you're listening to the show, we're going to be talking a little bit about what they call the lost decade. You may have heard the past 10 years referred to as the lost decade, and what people mean by this in the investment world is that the return of the U.S. stock market, namely the Dow or the Standard & Poor's 500, has been essentially zero, maybe a little bit negative, maybe a little bit positive, depending on when exactly you measure the time frame. But essentially, for all intents and purposes, the past 10 years, an investor in the S&P 500 or the Dow has received virtually no return, and that includes dividends as well. If you had really bad timing, in fact, you could have lost a significant amount of money. And so we're going to be talking about a few of the lessons learned from the last decade. The first lesson that we'll talk about is that reality often has little to do with what investors expect. And this is a very important point. In fact, if you look at whenever expectations are very high by both professional and individual investors, the returns typically are very low. And when expectations are very low, the returns end up being very high. And Mark Twain once said that prediction is difficult, especially about the future. I just love that quote because obviously prediction is about the future. There was, back in 1999 and 2000, no statement was truer than that statement that prediction is difficult, especially about the future. As we look at found this blog on the Motley Fool website, has some great quotes from people back in 1999 and 2000. I'd like to read a couple of them to you. In October of 99, James Glassman, the author of Dow 36,000. Now remember, the Dow tracks the 30 largest companies in the United States, and right now it's somewhere between, around 10,000. Well, back in 1999, this author was predicting that the Dow would be, he wrote a book on the Dow going to 36,000. And he said, what's dangerous is for Americans not to be in the market. We're going to reach a point where stocks are correctly priced, and we think that's 36,000. It's not a bubble, far from it. The stock market is undervalued. And in fact, the dot-com PEs at the time were astronomical, most over 40%. Joseph Battaglia, a market analyst, said, some fear a burst internet bubble, but our analysis shows that the internet accounts for only 7% of the overall NASDAQ market cap, but it carries expected long-term growth rates of twice those of other rapidly growing segments. The fact is the internet index lost 2/3 of its value in the next 6 months. Ralph Acampora of Prudential Securities said, I'm not saying this is a straight line up. I'm not saying you can't have any kind of declines, but buy them. And he predicted a 14,000 Dow by year-end 2000, an 11-year bull. Larry Kudlow of CNBC, this correction will run its course until the middle of the year. Then things will pick up. Not even Greenspan can stop the internet economy. And so you see, and I have pages and pages of these, Hopefully you don't catch us making those type of predictions on this show. We tend to stay away from bold predictions. What we do like to do is study history and use history as a guide, but it's always dangerous, whether in finance or anything, to extrapolate a trend in a straight line, that just because markets are going up is very dangerous to assume that they will continue in that direction. Another big lesson, kind of a corollary to what I just said, was that don't chase performance. This was made abundantly clear in the 1999-2000 tech bubble. At the time, if you go back, you remember that it seemed like personal computer stocks, anything related, anything with .com in it, people were just buying and they were paying any price for it. It took less than 2 years for this whole thing to unravel, and companies like Microsoft, Cisco, Intel, they're still in business, fortunately, but they're not anywhere near close to recouping the value that they once had at that time. Of course, many of those companies are out of business, and people lost billions of dollars investing them. Some of the bigger names, you remember WorldCom and Enron, Adelphia Communications. These were all companies that actually went bankrupt. One other thing with chasing performance is very difficult. In today's environment, we see that the correlation among stocks within an index are at all-time high, and it's very difficult to pick the individual stocks that may be winners. In fact, at this time, we're recommending that people stick with the industry, country type allocations and stay away from individual stock picking. You hear the term stock pickers environment. Well, there are times where it is not easier, but it is more advantageous to use individual securities when there's great disparity between the returns of companies. Now is not one of those times. The past 10 years, the market, what industry a company is in, what country that company is in, those have been the drivers of the market, not the individual idiosyncrasies of the companies. Lessons 3 and 4 were don't forget small cap and don't forget value. That the large companies were the talk of the world in 1999-2000, but actually small companies ended up eking out a gain over the past 10 years, as did value companies. Microsoft, Cisco, all these companies at the beginning of 99-2000 were what we call growth companies. But value companies, companies that typically pay dividends, typically are lower valuations, don't forget having those type of companies in your portfolio, because over the past 10 years, it would have served you very well. Well, that's going to bring us up to our first break. When we come back, we'll continue to talk about some of the lessons learned from the last decade. For All Things Money, I'm David Blain, and we'll be right back after a few short messages.